Good morning, everyone. This is Stuart. Hope you had a good weekend. This week, we will be covering updates in the economy, earnings and valuations, whether there's an ongoing unwind in U.S. assets, and potential investment opportunities. Quickly on disclosures, investing involves risk, and past performance is no guarantee of future results. Economic headwinds are growing at the moment. The U.S. economy faces multiple pressures from tariffs, retaliation from trade partners, lower consumer confidence and corporate confidence, negative wealth effects on consumer and business spending as the stock market declines, potential layoffs at the federal level. The first quarter GDP numbers per the Atlanta Fed real-time measure are tracking negative, and in the coming weeks, we'll see how the second quarter begins to look. Earning estimates for the S&P 500 are turning negative. The year started with consensus estimates of 275 in S&P earnings. That's now down several percent. The risk to the index is that we do get some sort of economic contraction, and the earning degradation to the S&P is more on the order of 5–10% plus. If we get 5 or 10% earnings decline and stay at the same 20 times multiple, we could be looking at a 10 to 15% decline in markets from this level. The real other risk is that the forward multiple on the S&P, which is 20 times earnings, contracts to mid to high teens, which is more historically in line with the average, in which case the decline could be greater. That's not our base case, but we do want to flag it as a real risk to the near and intermediate term. U.S. stocks remain outliers from a valuation and return perspective. The U.S. markets are down 10 to 15%, whether you're in the S&P or NASDAQ. Most other foreign developed markets are flat or up. From a valuation perspective, the U.S. is trading at about 20 times earnings compared to low to mid-teen multiples for other developed markets. The question is whether the U.S. still deserves that premium valuation multiple in light of all the policy changes that are happening. The risk is that investors globally conclude that we don't. Where could you see evidence that investors are turning away from U.S. assets besides stocks? Well, one is the dollar is weakening, down about 10% to start the year. Gold is looking to decrease their dollar or treasury exposure, and treasuries do remain volatile. 10-year yields are about 4.4% this morning, up about 40 basis points since the start of all this trade chaos. Risks and opportunities. If you do need near-term cash, we still think it makes sense to ensure sufficient liquidity in your portfolio. Consider allocation changes, quality of your holdings right now. As we've said over the last few weeks, the driver of returns is likely to shift from multiple expansion to earnings growth. And we want to focus on firms that not only have sustainable growth opportunities or stable business operations, but that might also have low sensitivity to all of the trade and tariff policy changes. Potential areas that we're looking at include energy, biopharma, beneficiaries from deregulation, and some select opportunities in AI. If your investing horizon is measured in years, it might make sense to start looking for opportunities as the market declines. We do prefer companies with a strong competitive position, stable operations, good balance sheets, meaning little debt, experienced management, a realistic pathway to demand growth, and again, reasonable valuations. If U.S. markets trade more at a mid to high teens multiple, we would prefer stocks that trade in line with that. If you have any questions or would like to talk about your portfolio, please do feel free to reach out. Thank you very much and hope you have a great start to your week.